All right. You guys having a good time so far? Man, that's weak. Are you guys having fun? Hey, listen, I am so amped for this next talk. I've actually been looking forward to hearing Travis speak ever since I met him. Just to give you kind of a quick history, so Travis Devitt and I met, about 2 years ago through a angel investing network, and we were the youngest guys by probably 20 years and became fast friends, and it quickly became apparent that Travis is probably the smartest guy I know. And he's got a decade of experience working with really big hedge funds, just has a really amazing knack for the markets and fundamental analysis. And so without further ado, give it up for my good friend, Travis Devitt.
Check. You guys hear me okay? I'm really, really happy to be here today, guys. This is a really big honor for me. I'm not probably a traditional speaker on the panel here. And when Chris first asked me, I was like, I'm not sure why you want me to come talk to a group of traders. I'm more of a fundamentals guy, more of a long-term guy. I've been working at a fundamental hedge fund. So I thought long and hard about what I would say to you guys and what I would talk about today. And Chris and Nikki both had talked to me about, really they wanted to better understand fundamental investing and how we approach the world on the hedge fund side. And I thought that made a lot of sense because, I think there's a lot of value to, let's see if we can get that back. There's a lot of value to understanding what else, Let's see if we can get this back. Cut to commercial. Anyway, I think there's a lot of value in being able to understand what other participants in the market are doing, even if they're not following your strategy, and basically always being a student of the market. So, just to give you a little bit more of my background, I have 12 plus years of public market investing experience, pretty much all with hedge funds. I say 12 plus, I guess, because I could include the few years of gambling my student loan money in penny stocks, but that doesn't really count, I don't think. But you guys were probably taking money from me back in those days. But the longest tenure I had was at a hedge fund. I was a partner at a hedge fund and senior analyst at a hedge fund called Teton Capital Partners. It files its SEC filings under Ancient Art LP, so if you're interested in checking out what stocks they hold, you can find their filings under Ancient Art LP. It was sort of like our way of trying to hide what we were doing from other people by calling ourselves a different name under our filings. But I joined them in 2008, early 2008, and we grew that from about $150 million in assets under management to about $1 billion today. So the fund was consistently listed in Barron's as one of the top hedge funds globally. We were, I think, 3 or 4 years running one of the top 5 long-short equity hedge funds in the world by performance. So it was an incredible run. Obviously, it wasn't just me. There was other guys on the team, but we approached the world with sort of a fundamental investing bottom-up perspective, which I'll talk about more in a minute. Other stuff that I do, as Chris said, Chris and I actually met through an angel investing group, so I do some private equity venture capital stuff on the side. And I've actually just stepped away from the hedge fund world to help build a company after being on the investing side. I wanted to kind of jump over the fence and see what it was like to build a company, so I'm working on that. But I think in a couple of years I'll probably start my own hedge fund. So what the hell is a hedge fund? There's a lot of talk about hedge funds in the media. There's a lot of talk about, you see it in movies now, like hedge funds are kind of the bad guys now, right? They're like usually, Donald Trump it's like his favorite target to talk about taxing these rich hedge fund guys. Are they a bunch of rich old white dudes? Are they the greatest financial minds of our time? A hedge fund is really just a limited partnership. You and I could start a hedge fund in our basement tomorrow. There's nothing special about being a hedge fund. So why do we always hear about them? The reason we hear about them is because the early returns to hedge funds were very incredible. Before everyone and their mother decided they wanted to start a hedge fund, there were a group of guys in the early to mid 90s who started an investment partnership that they called a hedge fund. And basically what they saw was that mutual funds, which were used to manage most everyone's money at the time in the stock market, were not really getting the job done. If the market was down 15% and the mutual fund was down 14%, they threw a party. And that didn't make sense to a lot of people. it didn't make sense that the mutual fund would charge you as a percentage of assets no matter how you performed. So the hedge fund guys said, you know what? Not only is the mutual fund industry way too overregulated, but they're not incentivized to perform, and they're not really structured to give you flexibility to do to go invest in really interesting things. So they started these new partnerships called hedge funds, and the hedge fund industry now is over $3 trillion in assets. There's over 1,000 hedge funds today. These top 10 hedge fund managers, these are the 10 wealthiest hedge fund managers in the world. They all are collectively worth over $100 billion. I said, fuck my life, because that's a lot of money. But the strategies vary tremendously across the hedge fund industry. You've got global macro, where they're trading interest rates, currencies, commodities. They're looking at the world holistically and figuring out what assets should we trade today to make money. You've got quants doing quantitative trading. You've got merger arb. And then you've got long-short equity funds, which is where sort of I made my bread and butter. And that makes up, equity long-short funds actually make up about, I believe, about 35% of all hedge funds. So it's the most common type of hedge fund. And basically, there's equity long-short hedge funds exist to pick stocks and do a lot of what you guys do. So why should you care about hedge funds? Obviously, they move markets. You trade with and against them all the time. And they're some of the most successful investors of our time. You may recognize a few of these guys. If you followed the Herbalife saga, you've got Bill Ackman. Bill Ackman over here on the right, Dan Loeb on the left was sort of opposite him. He was short Herbalife, he was long Herbalife, and they battled, and Icahn got involved too. You probably hear about Carl Icahn all the time because he's an activist, but there's lessons to be learned from a lot of these guys because a lot of these top hedge fund managers have compounded returns at 20 to 25% a year for a decade or multiple decades. And those are the kind of returns that will create 10, 20, 30x your wealth over that time frame. So how does hedge funds relate to fundamental investing, which was the topic that I want to talk about today? So I estimate about 65% of professionally managed hedge funds use some type of fundamental valuation technique. And at least 15 of the top 20 richest hedge fund managers in the world built their empires using fundamental strategies. Also, the second richest man in the world, you may know him, Warren Buffett, worth about $68 billion as of last count, is obviously a fundamental value investor guy. My goal today really is just to make you better. You may not decide that you want to be a fundamental investor, but hopefully I've got some things that I think that you can use in your toolkit, help you understand the markets better, like I said, and just give you some tools to increase your wealth and maybe one-up your annoying uncle at the next get-together. So the areas I'm going to focus on, financial theory versus practice. I'm not just going to give you the textbook stuff. I'm going to tell you a little bit of the textbook stuff and then how it actually applies in the markets, and give you some examples of some stocks that I invested in and why. Talk a little bit about stock selection, how how we went looking for interesting ideas. And this I think could be pretty helpful. I mentioned yesterday I'll talk about position sizing and some ways that you can think about how to correctly size your positions. And I'll talk maybe about some current ideas too in the market that I think are interesting. So how do you determine value, right? What is value? There's a lot of different assets in the world that you can own. Here we've got a residential house, right? There's some intrinsic value just because you have to live there. It's your shelter, right? But there's also a market where you buy and sell houses, and the market says that a house in San Francisco, on average, is worth more than $1 million, and it says the average house in Detroit is only worth $40,000, which is pretty interesting. This, I think, is appropriate for where we are today. This is a painting called Card Players by Paul Cezanne. It's at last trade, it was worth $300 million, but you can't really do anything with it but look at it. It's interesting. And then here you've got a share of Apple Computer. So the question is, does price equal value? I want to use an example here. If I had a $1,000 Amazon gift card right now, and I said, hey, what are you willing to give me for that $1,000 gift card? Probably be close to $1,000, right? It wouldn't be $1. It would probably be $999 or $1,000 because that is the fair value of a $1,000 gift card, right? Well, what if there was only one person in this audience and that person didn't like to shop on Amazon, didn't own a computer, and he said, all right, you know what, I'll give you $5 for that Amazon gift card. Would that $1,000 Amazon gift card be worth $5 because the one guy in the room bid $5 for it? Interesting thought, right? So for me, I think there's a conceptual difference between price and value. Drivers of price are sentiment, mood and sentiment. and also to some degree market liquidity and depth and the information that those participants in that market have. And then on the other side of the fence is value. And I think value is, for the most part, driven by cash flow, underlying cash flows of an asset, or maybe in the case of art, some other type of benefit or enjoyment that you receive. But cash flowing assets are a lot easier to value, I think, than something like art that doesn't throw off cash flows. But traders make their money exploiting by buying assets that they hope will have favorable price changes, anticipating the changing market sentiments, right? And value guys, or value investors, are looking to buy assets that deviate from their intrinsic value. So we're exploiting two different things. Traders are trying to exploit price, and long-term investors are trying to exploit value. Great, okay, so what does that mean? All right, how does one value a stock? What does that mean? Go back to that example of Apple Computer share, right? What is a share of stock, right? A share of stock is a share of ownership in a company. It's a claim on a percentage profit that company will generate. And a company exists to generate cash profits. If it doesn't, it goes out of business, it goes bankrupt. So therefore, a share of stock is a cash flow generating asset. It is a claim on cash flows. And the value of a share of stock is the sum of all the cash flows that the owner of that share will ever receive over time. And here's the thing, discounted by a factor that accounts for how long it takes to receive those cash flows. Let's go back to that $1,000 Amazon gift card example. So if I said, okay, great, here's a $1,000 Amazon gift card, you can buy it from me, but I'm going to mail it to you in 5 years. What would you pay for that? Would you still pay $1,000 for that Amazon gift card? No. You're going to receive it in 5 years. You're going to tie up $1,000 of your cash in something that you won't receive for 5 years? No. You'd be willing to pay something less than $1,000 today for that future benefit of $1,000 5 years from now. That, in essence, is called, that forms the basis of what we call discounted cash flow in corporate finance. It underpins almost everything in modern day finance, and certainly is the core of valuation techniques. So if you remember anything today, as far as valuation goes, remember cash flow is the most important thing. It's not revenues, it's not total assets. Cash flow is the lifeblood of a company. Cash flow is what determines value when you're looking at valuing a company. And I'm going to run through just a real quick, bear with me here. I know this is probably pretty boring. We'll get to some fun stuff here in a minute. But I just want to talk about discounted cash flow and what it is and why people use it or why people don't use it. So it works really well when your time horizon is finite. The asset that you're looking at has a finite horizon, and the cash flows are pretty well known, and they're not very volatile. So it works great if you're a company and you're looking at investing in maybe a certain type of equipment or a certain factory or a certain type of asset that's going to last a couple years, and you know generally what it's going to produce. And so you can see here in this example, if you've got something that will throw off $100 for 3 years, the value of that actually isn't $300 because we need to, especially this third year where we've got $100, it's not actually worth $100 today because we could take that same $100 today, invest it in some bonds or a safe asset, and actually have by that end of the third year more than $100. So to discount for that fact that we're not receiving that cash later, we use a discount rate. And I won't bore you with the formula. It's really just the cash flow divided by 1 plus the discount rate. But the value of that cash flow at the end of year 1 is $90.91. The value of the year 2 cash flow at the end of year 2 is $82.64. And the value of the year 3 cash flow is $75 for a total value today of $249. So if you're looking at this asset that throws off $300 of total cash flow over 3 years, using a 10% discount rate, you would actually be willing to pay $249 today for that future stream of $300 cash flows. Makes sense, right? Now the problem is that DCF doesn't work well when the cash flows are volatile, when you can't really estimate them well, when discount rates are changing rapidly, when the time horizons of the cash flow are really not known, right? And let's think about again what a stock is. A stock is a company that's trying to create profits basically forever. So a stock is a very long-lived asset, and it's very difficult sometimes to estimate what a stock is going to produce in terms of cash flow. This is an example of Netflix. This is Netflix stock from early 2010 through the end of 2011. Basically, it went from a split-adjusted price of $10 a share to over $40 a share. It went up 4x in about a year and a half. And then within a span of about less than 6 months, it was down from 40 to, again, $10. So it was down 75% in less than 6 months. And by the way, it went up again another 10x since then through basically last week. How the hell can a stock, if you're valuing something, how can a value change that dramatically? How can it be down 75% and then up 10x? It doesn't really make a lot of sense, right? Well, cash flows are hard to estimate accurately. So there's a lot of things that go into forecasting cash flows. What is Netflix going to earn over the next 10 or 20 or 30 years? You've got to forecast revenue, which depends on the state of the economy. It depends on the prices that they're charging. It depends on what their competitors are doing. You've got to figure out, well, what do their expenses look like? Are their raw material costs increasing? Are they having to pay higher wages? What are they having to spend on marketing? Do they need to invest more cash in generating in new assets? Do they have some kind of crazy legal expenses? Are they doing share buybacks? Are they spending money buying back shares? So there's all these things that can affect cash flow. This is not a roulette wheel. This is actually Netflix's annual operating cash flow from 2008 to 2014. I don't know if you guys can read that, but basically the direction wasn't even consistent. Up, down, up, down, up, down. Every year. So one year it was up, the next year it was down. Next year it was up, next year it was down. Next year it was up, next year it was down. How the hell are you going to forecast cash flows when they're doing that? And oh, by the way, they went from $284 million in 2008 to 17 million in 2014, and that's in a period when Netflix is actually growing its subscriber base massively. So there's some other problems with DCFs as well. I won't go too much into them, but the discount rates is one of them. And discount rates, there's this whole academic set of papers and really a whole industry devoted to figuring out what are the right discount rates to use. It involves things that like CAPM and WACC and beta and all these stupid things that are mostly academic mental masturbation in my opinion. But had we used a 5% discount rate in that example where I looked at the $300 cash flows, had we used a 5% discount rate instead of a 10% discount rate, the value that we would have been willing to pay today was $272, not $249, right? So the value is determined on these discount rates that are really hard to determine. So what do we do then? If we're not good at doing DCF for stocks, we're going to use shortcuts, and that's what people do. So we see price to earnings multiples a lot. You guys probably look at PEs, right? Or at least you've heard of them. You hear people talk about them. You hear earnings per share, price to earnings ratios. Maybe if it's a company that's not profitable, you hear about price to revenue multiples. That's typically for tech stocks that aren't profitable yet that are growing quickly. And then EV to EBITDA multiples for companies that are being levered or bought by private equity firms. So these can be both used as an absolute and a relative valuation comparison. So a PE, for instance, you can compare McDonald's to Wendy's and say, well, McDonald's trades at 19 times last year's earnings, and Wendy's trades at 25 times last year's earnings. So Wendy's is a more expensive stock, right? I'm not going to worry about that slide. But what are earnings? Because that is a term that needs to be clarified, right? I was talking about cash flows earlier, now I'm talking about earnings. Well, earnings is basically net income of a company. It's the bottom line. After when you look at a company's income statement, when you get to the bottom, after taking revenue, subtracting the various types of expenses, taxing it, you get down to what's the bottom line income that's available to shareholders, and that's called net income or earnings. And earnings are not cash flow. Earnings are an accounting measure that are used to actually smooth out the lumpiness of cash flows. Accountants would say, well, if you're going to spend $100 million to build a new factory this year, and you spend all that $100 million and you build the factory, that factory will last for 10 years. So you need to depreciate the cost of that asset over 10 years, over its useful life, rather than saying, well, your cash flow went down $100 million because you spent it on this factory. And then you'd have a really, really low cash flow number in the first year, and then over time you'd have a lot better looking cash flow numbers, right, if you were just looking at cash. But earnings is trying to do the opposite of that, which is smooth it out and say, get a little bit more steady a figure at what that firm is earning over time. The problem is there's a lot of differences between net income or earnings and cash flow per share. And so what you see is, one of the things I just mentioned, obviously, depreciation is one of the big ones. There are a lot of other non-cash expenses. Sometimes companies are paying cash taxes, but not, they're showing taxes on the income statement, but they're actually not paying cash taxes to the IRS. There's stuff like that. And so sometimes earnings can deviate dramatically from cash flow. Earnings can also be gamed, by the way. I don't know if you guys are familiar with a stock called American Superconductor, ticker symbol AMSC. It's an interesting company. And they essentially made controllers, electronic control panels for windmills. And they helped power sort of the internal core electronics of windmills. And for a while, they were selling, at least they appeared to be selling, a ton of these electronic control boxes to windmill makers in China. And they were showing really, really high revenue growth over time. But there was an interesting thing happening. Revenue was being recognized, but cash wasn't coming in. The balance sheet, when you look at the balance sheet of the company, cash wasn't growing. Well, how are you growing revenue dramatically, but cash isn't growing? And the reason was because they had a huge receivables balance that was growing. So they were paying, they weren't paying, they were billing the company for these electronic control panels, and they were actually shipping them to these companies in China. And the problem was they weren't actually receiving money back from those companies. So they were booking revenue fictitiously, and the way that it showed up on the income statement was it showed up as revenues, but on the balance sheet, it showed up as this big cash receivable that they actually never received. And so, I looked at that and I said, something's fishy here. Their receivables balances are over 120 days long. Like, it's taking them over 120 days to receive any cash from any revenue that they generate. And they're only selling to Chinese companies. They're not selling to some of the largest windmill makers in the world, like GE. Like, what's up here? And it turns out there was straight up accounting fraud. AMSC, I think now is on the verge of bankruptcy. The stock dropped, I think, like 80% in a matter of like a few months once it came to light what they were doing. So you gotta be careful with earnings. Some of the other things. So when we talk about price to earnings multiples, so the price to earnings multiple, right, is the price of the share, or the share price of the company divided by the earnings per share equals the price to earnings multiple. And multiples are applied to get a rough estimate of the sum of future earnings, right? So if a company earns $100 this year, that company's obviously worth more than $100, right? Because it's going to continue earning potentially $100, or maybe it grows its cash flows over time. So a multiple is used to apply. It's a shortcut basically to get to that figure that we're trying to get to with DCF, which is the sum of the future earnings or the future cash flows of the company. And they expand and contract based on what the price of the company is doing. And they expand and contract often on the expectations in the market of how their earnings are going to grow, what the business quality is like, the strength of the economy. And faster companies deserve higher multiples, right? So if a company like Salesforce.com is growing its revenues at 40% a year, then it should trade at a higher multiple to reflect the fact that this year's earnings, which you're putting a multiple on, could be double that in a few years. And so high growth companies have high price to earnings multiples, and they're justified oftentimes. And low growth companies have low multiples. So when you look at BlackBerry, right, a stock that's shrinking, like everyone's giving up their BlackBerries and buying iPhones and Androids, BlackBerry has like a 4 times earnings multiple. So the market's basically saying, yeah, your value of your entire company is only worth like 4 years of what you're making today. Like, we don't believe you're going to make this amount of money for more than 4 years. So an interesting example, I think, of showing what PE multiples and how share prices react to changes in price to earnings multiples is First Solar, a company that I know well. They make solar panels. They're actually a US-based company. One of the leaders in solar panel manufacturing. And in early 2011, they were a stock market darling. They were trading at an average market multiple of about 15 times price to earnings, and earning about $10 a share. So they were trading at $150 a share, earning $10 in EPS. They had a 15 times earnings multiple, but something was happening in their industry. The other players in the industry were mostly Chinese solar panel producers. They were reducing their costs dramatically. They were increasing capacity. They were really pressuring panel prices, right? And so what happened was the market for panels collapsed. At the same time, also, there were a bunch of countries that were offering tariffs for people to build solar projects, basically giving people cash to build solar because they wanted to incentivize that. And they figured out that was probably a pretty bad idea after people ran amok with it. Like, Germany was the largest installer of solar panels in 2011, and Germany is like actually one of the worst countries in the world for like sun irradiation. So they get very little sun. It makes no sense. Why would they be the #1 installer of solar panels globally? So you had all these things, kind of confluence of factors happening. And within about a year, not only did earnings shrink, but the multiple of that earnings shrank. So you went from a $10 EPS to a 15 times earnings multiple, which got you to a $150 share price, to a $3 earnings per share with a 4 times multiple and a $12 share price. So there was both a very real decline in earnings that happened at First Solar, and then a very kind of market momentum-driven contraction in what the market was willing to give as far as a multiple of earnings for First Solar. So the result was basically a 90% decrease in share price. So, all right, valuation. It's just like you see Netflix, you see First Solar, and it just feels like it's more art than science. So like why do we even do it? Why even bother, right? Like why do we even give a shit? Why even try? Just go make meth. Be like Walt. But the thing is, it's not all hopeless because there are a lot less volatile stocks that you can find. There are stocks that compound earnings growth over time consistently. This is this is Priceline.com from about 2006 to 2014. It's hard to tell from this chart, but it went from about $50 a share to about $1,250 a share. It was one of the best performing stocks of the decade. And it really didn't, other than the financial crisis of 2008, it really didn't have any dramatic, I guess there was a pullback here too, but it consistently grew earnings over time. The share price consistently grew over time. By the way, I bought that stock at 50 and sold it at 120, and that was the stupidest thing I've ever done. I made money, I guess, but I left like 10x on the table, so don't do that. Let your winners run sometimes. So I want to talk about another example. So thinking like a fundamental investor, so there was an interesting case study a couple years ago in the hard drive industry. The hard drive industry historically was like a really shitty business. There were a lot of players, a lot of like commodity. It was a commodity industry. There were a lot of players in China that churned these things out. The prices were constantly decreasing. Industry capacity was always oversupplied, and so people just thought these were shitty businesses, shitty companies, and an interesting thing started happening. A lot of those players that were supplying that overcapacity in the market went bankrupt. And so what happened was there was an opportunity because there were basically two players left by the end of 2010, 2011. There were two main players in the hard drive business left, Seagate and Western Digital, tickers STX and WDC. Another interesting thing was happening while this industry was consolidating. Demand for data storage was growing dramatically. So the explosion of devices, the explosion of data in the enterprise was creating a real demand for more storage. And another thing that the companies were doing smartly at this time were they were buying back their shares. They were trading for single-digit price to earnings multiples, and the market was trading for 15 to 20 times. And so these companies were trading at discounts to the market multiple, and they were also buying back their shares in the open market. So they were shrinking the number of shares outstanding, meaning that the remaining shareholders owned larger percentages of the company. And so by doing those accretive share repurchases and also rationalizing price in the industry, there was this opportunity where the sentiment of the market said, hey, these are shitty businesses. But if you spotted it early enough, you could say, no, actually, things are changing. This industry's changing. This industry's different. And Western Digital went up 4x in about 3 years, and Seagate went up about 5x in 3 years. And you see this a lot, actually. You see it in the airline industry. Warren Buffett famously said airlines are terrible business. But airlines have been some of the best performing stocks of the last 3 years, right? Because something interesting happened in the airline industry. It's not just oil being lower, it's also the fact that they consolidated. There are only 5 or 6 major US airlines now. And a lot of them focus on regional routes. And honestly, they've kept capacity tight. They're not buying that many new planes. So if you get on a plane, usually you'll see it's pretty full. And so the industry, where it used to be like, let's just buy new planes every time it looks like demand is okay and oil prices aren't spiking, every time they buy new planes, it would just oversupply the market and they'd have to drive down prices on plane tickets. Well, that's not really happening anymore. They're enjoying some of the best profits they've ever had. So this sort of thing happens a lot, where you've got turning points in industries and companies, and if you can see them early enough, there are massive opportunities to make wealth. Some things you have to watch out for, obviously, are value traps. And things can look cheap sometimes. Like if you look at a stock and you're like, oh man, it's only trading at 5 times last year's earnings. Well, you would see that actually today with oil and gas companies, right? It looks like based on last year's earnings, man, these things are cheap. Well, things are changing. Things have changed. Oil price at $40, $45 means they're earning maybe nothing, but certainly a lot less than they were the year before. So you have to be careful when you're looking at earnings multiples, especially old earnings, like last year's early earnings or trailing 12-month earnings. You really have to look forward, because the market discounts a lot of what's going on. It really adjusts prices to reflect what people expect. And it does it quickly. I mean, you'll see that if a company gets acquired, right? There's an announcement that a company is getting acquired, the share price immediately jumps to almost the price of what that other company is willing to pay, because the market is essentially not going to allow you to take advantage of something that is obvious to all the other market participants, right? So sometimes you'll be like, oh, well, this stock looks really cheap. Well, it's not really cheap in reality when you look at what that industry is doing and what that company is going to earn in the next year. And so another thing is that good companies don't always make for good stocks, and bad companies actually don't always make for bad stocks, right? Like Tim Sykes proves that, like penny stocks, right, prove that. So people always ask me, like, well, should I buy Apple? Like, I use its products, it seems like a great stock. Or should I buy Tesla? Like, the cars are amazing. Well, you have to take into account price. You have to take into account if there's intrinsic value. Is it being reflected in the market? Like, I don't want to overpay. Tesla's a great company, but do I want to overpay for its shares? All right, so I've been talking a lot about probably some pretty boring stuff to you guys. Value investing, fundamentals, whatever. So maybe you're still not buying what I'm selling. But I've got something for you. I've got something to add to your toolkit. Position sizing. Your wealth depends on it. So sizing your positions correctly can really be the difference between wealth and ruin. Did you know that you can win on less than 50% of your trades and still come out ahead? If your winners are producing more profits than your losers are producing losses, that can absolutely be the case. Another thing to take in mind is losses really, really kill you. A 50% loss means if you started with $100, you lose 50%, you're now at $50. You've now got to go up 100. You've got to go up 100%, not 50%. If you're down 50, you got to go up 100% just to get back to break even. If you're down 75%, you actually have to go up 300% now to get back to break even. So if you go from $100 to $25, you lose 75%. Now that 25, you have to 3x that $25 just to get back to 100, just to get back to break even. So controlling losses is huge. So when you think about how do you size your positions, how do hedge funds size their positions? How do the smart guys do it? Because if there's a non-zero chance that you're going to lose money, why would you ever commit 100% of your account? You expect at some point, if you're using 100% of your account on one trade, over time, if you expect not to win 100% of your trades, which you shouldn't, then you are expecting that you will lose all of your account, or you're expecting to at least take a massive hit on your account. So position sizing is really huge. So there's some interesting theory behind position sizing. I don't know if you guys know who any of these guys are. This is Claude Shannon. He is the author of one of the most famous and most important research papers of the 20th century. It's called A Mathematical Theory of Communication. And it sort of forms the basis of a lot of the fundamental technologies we use today in computing and circuitry. He was a brilliant guy. Seriously, the paper, I tried to read it, but I didn't understand it. But it is one of the most important fundamental papers. He was working at Bell Labs at the time when he wrote that. There was another guy, John Kelly. John Kelly was at Bell Labs with Claude Shannon. And John Kelly actually read the paper, understood the paper, talked with Claude a lot, and actually developed what he called the Kelly criterion, which is going to form the basis of what I'm going to talk about in a minute, and became hugely important in a couple different areas. This is Ed Thorpe. You guys probably heard of Ed Thorpe, maybe heard of Ed Thorpe. I heard his name mentioned yesterday, actually. He wrote a book called Beat the Dealer. It's appropriate for where we are today, right? We're in Vegas. So Ed Thorpe, in the 70s, wrote a book called Beat the Dealer. It became the treatise on how to win at the casino. It basically proved that with the help of card counting, with the help of getting a slight edge in a game, and position sizing correctly, sizing your positions correctly, you could actually make a tremendous amount of money and beat the casinos. So actually, Ed Thorpe and Kelly tested this out, and they went and they actually got kicked out of a bunch of casinos because they bled them dry for a little while until the casinos figured it out that they were card counting. It also forms a lot of this theory that in Beat the Dealer forms the basis of the MIT blackjack card counting team that was the source of that movie, Bringing Down the House. So what is the Kelly criterion? And what does it mean for position sizing? The Kelly criterion is a mathematical formula that answers the question of what's the optimal bet size. It is a formula that determines a utility function that maximizes your wealth over time, given a certain probability of winning, so the probability of your winning trade, and the payoff of that trade. And so the formula, and I'm not going to go too deep into it, it's pretty simple though. It's the percentage of your bankroll that you should wager is equal to the probability of winning times, in parentheses, the payoff multiple if you win, plus 1 minus 1, over the payoff multiple if you win. Basically what it means is, the way the math works out, and you can play around with it, and you should read about it, is if you have, for instance, if you have a 60%, if you believe that the chance of winning your trade is 60%, and the payoff of that trade is 100%, so you doubled your bet. So if you bet $1, you get your bet back plus an extra $1. If it's a 2-to-1, and you have a 60% chance of winning that trade, the Kelly formula, the Kelly criterion actually says you should bet 20% of your portfolio on that trade. It's a big number, right? It gives a surprising conclusion because most people, I see two different sides of this actually. I see people that are, especially in the hedge fund world, that are taking too small position sizes or they're taking too large position sizes. And the Kelly criterion is literally a mathematical formula that answers how do you, over time, maximize your wealth with the correct bet size. I encourage you to read about it because I'm not going to be able to explain all of it here, but it is used by Warren Buffett. It is used by Ray Dalio at Bridgewater, $100 billion hedge fund, one of the most successful hedge funds of all time. Ed Thorpe actually used it. Ed Thorpe created an investment partnership himself and did very, very well. I think analyzed over 20% returns for over 2 decades. One of the best performing hedge fund managers of all time. He started a quant hedge fund. His name is James Simons. The hedge fund is called Renaissance Technologies. They have their fund called the Medallion Fund. It returned over 30% for over 2 decades. It was probably the best performing hedge fund in the 80s and 90s. He uses the Kelly formula, or a modified Kelly formula, to size his positions. So it's very important. But one word of caution is that the Kelly formula does spit out pretty high numbers. And to estimate the true probability of winning on any given trade is a little bit difficult. I mean, you think you might know. Maybe you have a history, maybe you have a track record of winning on 65% of your trades over time. That doesn't necessarily mean your next trade is going to be a 65% chance of winning. But hopefully, if you develop a system over time, it should be close to that number. But to account for the fact that there's some inability to exactly estimate what the probability of you winning on any given trade is, most people half what the Kelly says to bet. So if the Kelly formula says you should bet 20% of your account or your portfolio on X trade, then you should, if you really want to manage risk a little bit more tightly, you should use 10% instead. You should use a half Kelly, basically divide the Kelly bet by 2. And that's a pretty good approach. We used that at the hedge fund that I worked at, and it worked very well. And we took fairly concentrated positions. Our average position size would be about 8 to 10%. But it worked. It worked very well because you want your best trades, your best ideas to be significant winners. And they can't be significant winners if they're 2%. That's the problem that mutual funds have. They're invested in too many stocks. They're too over-diversified. They track the market. A lot of hedge funds do that too. But the good ones don't. So that's pretty much it. There's some cool reading and resources I've got up here if you want to check them out. I talked about a couple of books yesterday. The little book of behavioral investing is pretty cool. Any of the Warren Buffett partnerships letters over time are really great. There's a great book by a hedge fund manager, David Einhorn, called Fooling Some of the People All the Time. It talks a little bit in the beginning about his management of his hedge fund, which is a $10 billion hedge fund called Greenlight Capital, very widely followed in the market. And he's been one of the more successful hedge fund managers of the last decade. But it runs through his management of his hedge fund and also talks about a situation that he had shorting a stock over the course of 5 years. And it was a fraud company, and it took him 5 years to basically expose this fraud, and it's a really interesting read. And a really interesting insight into like long-short equity managers like Einhorn. If you want really technical corporate finance stuff, you want more of that, which I don't know why you would, but if you do, there's a book called Analysis for Financial Management that I really like that's I refer to sometimes. And then also this book, The Outsiders, 8 Unconventional CEOs. If you're a fundamental value person, that's a book you absolutely should read. It's about 8 companies that basically more than 10 or 20x their stock over a decade, and the way that they did that, and it's a really interesting insight into finding management teams that really create value consistently over time. And then Ed Thorpe's paper on the Kelly criterion is also really good. And Market Wizards, which was mentioned yesterday, obviously a great book. I think a lot of us have read it and definitely recommend reading it. So I don't think we're doing Q&A, but there's a couple things like just ideas that I've been poking around on lately, just to kind of give you a flavor of what I've been looking at in the stock market lately. I've been looking a lot at the auto sector. I don't know if you guys saw the news on Volkswagen with the emissions cheating that they were doing, but it's created a lot of downward pressure on share prices across the industry. And I saw an interesting post the other day. Someone was breaking down who they thought would be potentially cheaters as well, who might have been cheating based on the types of engines they used and the types of technology. And one of the companies that was singled out was GM. So GM's one to be careful of because it's potentially could come out that at least one of their divisions, Opel, could have been cheating on emissions as well. So I'm watching that sector. There's also a special situation there with FCAU. It's Fiat Chrysler. And they're about to spin off Ferrari. So they own Ferrari as one of the brands they own. They also own Jeep and obviously all the Fiat brands and some of the Chrysler brands. But they own Ferrari, which is a really nice asset, and they're about to spin it off. And FCAU is trading at a really cheap multiple in the market. And when they spin off Ferrari, assuming Ferrari, so Ferrari, because it's part of the overall company, is getting valued at the same multiple as the entire company. Well, Ferrari deserves a really high multiple because it's a really great business. It has a really great brand, a really great earnings potential. So when they spin Ferrari out, Ferrari's going to have a really nice multiple, and it's actually going to make the remaining value of FCAU look even lower than it is today, which will be really, really interesting. Brazil is a really interesting place to look right now. There are a lot of actually Brazilian stocks that trade in the U.S. market. I think there's a lot of value there because the Brazilian real's down 30% versus the US dollar, and a lot of those Brazilian stocks have gotten crushed. And a lot of those Brazilian stocks are resource stocks, like oil-related stocks. But there are some other players, like I mentioned Arcos Dorados yesterday, which is the largest franchisee of McDonald's. They're still growing sales positively right now, even in a recessionary environment in Brazil. So some interesting stuff. Micron, it's one that's talked about a lot, MU. It's been whipping around lately. I think what's happening in their industry is very similar to the hard drive industry, like we talked about earlier. There's a lot of consolidation. There's a lot of change in that industry. There's really only two main players of DRAM and NAND memory, and memory is not going away. If anything, the demand is increasing. You're going to go from a gig of memory in your iPhone this year to having a 2 gig chip next year. So there's some interesting dynamics happening in that industry. Short term, some ugliness, but it's a pretty interesting place. Some special situations like Yahoo spinning off their Alibaba stake. That's interesting. The ad tech sector, there's a bunch of these stocks that went public. They've all gotten crushed, except for Criteo. I'm kind of looking at a paired trade, maybe short Criteo, long Rocket Fuel. Some interesting dynamics there. But yeah, so there's a lot of fun stuff out there in the market right now. I think there's a lot of opportunities both for trading and investing. Yeah, if you want to chat about it, let me know. So that's it. Thanks, guys.